Warren Buffett has two rules for investing. Rule number one, don't lose money. Rule number two, don't forget rule number one. In this episode, I'm going to address the question, why does a max-funded IUL have more predictable returns than money invested in the stock market? So by the end of this video, you will understand why an IUL policy has a guaranteed floor. You won't lose due to market volatility, but participate in upside potential. Get ready. So I'm Doug Andrew, and I began in the financial services industry clear back in 1974, so nearly 5 decades now. And from 1974 until 1980, for 6 years, I helped people sort of buy term and invest the difference, because at that time I was a big proponent of that, because I think you could outperform what was usually whole life insurance that only maybe had 2, 3, 4% rates of return. And I was trying to achieve more like 12% rates of return for my clients in a portfolio of mutual funds. So what ended up happening during that period, and I ended up with over 3,000 clients that I was responsible for in 13 Western states. They were never happier than when I got them out of the stock market in 1980. What happened in 1980? E.F. Hutton, who was not an insurance company, they were a brokerage firm, realized that even if you could earn, let's say, 12%, which most people don't because they buy and sell at the wrong times, you're not netting 12%. Even if you put it into a tax-deferred IRA or 401k, because most people are going to pay back about a third of that in taxes, either sooner on a Roth or later on a traditional IRA or 401k. Probably around a third will go out the window in taxes between federal and state income tax. So you're not netting 12, you're netting maybe 8%. And then a lot of these asset managers charge 1% asset management fees. So if you're earning 12%, you're only netting 7 or 70,000 on a $1 million nest egg if you're not wanting to deplete principal to buy gas and groceries, prescriptions, and golf grain fees, okay? Back then, E.F. Hutton said, what are we thinking? Let's look at the multi-trillion-dollar insurance industry, the backbone of America and the backbone of the world. So what they meant was, these are some of the best money managers in the world, and if you have money that accumulates inside of a life insurance policy, it's like a sacred cow in the Internal Revenue Code. Sections 72E, 7702, 101A have been around in one form or another for over 108 years. But up until then, the rates of return were fairly poor. That's why we had buy term invest the difference. They said, why don't we buy term and invest the difference under a tax-free umbrella? And let's get a rate of return that is within 1% of the gross rate of return by taking the least amount of insurance the IRS will let us get away with and put in the most money the IRS allows as fast as they allow. Now, I have other episodes on this very channel that talk about this, so I would recommend that you subscribe. It's free, and I post a new educational video almost on a daily basis. But let's just cut to the chase. If you take the least amount of insurance that the IRS will let you get away with, and you put in the most money the IRS allows under 3 tax citations, they're called TEFRA, DEFRA, and TAMRA. They're explained on other episodes on this channel. This turns into an instrument that accumulates your money, where I've averaged 9.6% rates of return. And so I'm actually earning more like 10.6 and netting 9.6. But I don't care if you earn 8 net 7 or earn 12 net 11 or earn 16 and net 5. We've had many people that in the year 2021, for example, that earned 61.33 and netted within 1 percentage point of that, 60%. And people say, really? I've never heard of this. Well, it doesn't mean it doesn't exist. What I have recommended for years, because from 1980 to 1990, based upon the insurance company's general account portfolio yield on their AAA and AA bonds and mortgages on shopping malls and skyscrapers. And if they do invest in stocks, it's a very low percentage and very conservative ones. But I earn between 11.75% and 15.5%, never less than that from 1980 to 1990. Now, in the late 90s, interest rates started to come down. And that's when indexed universal life was introduced. And I thought, wow, now this is great, because now I can participate when the stock market, so to speak, goes up, but not lose when it goes down without my money at risk in the market, so I won't lose Warren Buffett's #1 rule. So what is indexing and how does it work? When indexed universal life came out in 1997, I immediately not only had my clients in universal life, but I began to have them opt in for the index universal life. Now, indexing is a strategy. I'm not talking about index mutual funds. So I'm going to explain it on this chart how it works, because in 1998, I was credited 21.98% on my index universal life policy. Tax-free, because this is tax-free. So what ended up happening is we had what is called the Great Recession, basically the turn of the century, around the year 2000, ending actually 12 years later in 2012. It's the worst 12-year period since the Great Depression. So let's just look at that 12-year period on a graph. And this actually starts in November of 1999. Okay. So what ended up happening in the market, and we're going to use the S&P 500, Standard & Poor's, and we saw it go like this. Now, in most 10, 12-year periods, you'll maybe have 3 loss years compared to 7 gain years in a decade. That decade, 2000 to 2010, there were 5 loss years. But I'm going to go 2 more years to 2012 to illustrate my point. So we had people, let's say, they spent their entire lifetime accumulating $1 million. So we'll use that. You can extrapolate from the $1 million. And so they saw that without adding any money, they saw that $1 million nest egg in their IRAs or 401ks invested in the market go down by 35, 40%. $1 million went down to $600,000 for many about to retire people. They felt like they'd lost their future, okay? They had to put off retirement 7 years because when you lose 40%, you have to have a 67% gain to make up for a 40% loss. People go, huh? If $1 million goes down to 600,000, 600,000 has to grow by 67%, 400,000 to get back to break even. So this is what happened during that time period. This is the break-even line, okay? And so I have 100,000 on the screen. I don't care if it's that or $1 million. If you lose 35, 40%, it took 4 years to come back to break even. Now, my clients who had indexed universal life, they did not lose a dime when that happened. They may not have made very much, but they stayed up here. And the minute the market turned around, they started making money up here. I'm going to show you the difference. People said, okay, we can finally retire in the year 2007. What happened in 2008? As Warren Buffett put it, he said, when the tide went out, it revealed who was swimming naked. What he meant by that is people weren't protected from that market volatility. People lost 40% on the average again. Some lost 50%. For the second time in a decade, none of our clients lost who had indexed universal life. They were cheering, go, 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 because they weren't losing anything. If they had just started, they were still up here instead of having to lose the money. And then as soon as the market turned around, which it did in 2009, many of our clients locked in gains of 16% tax-free the first 90 days of 2009 after not losing a dime due to that market crash of 2008. People say, what? How did they do that? With indexing. And then the market, it took until 2012 to where, 100,000 was worth $104,680. That didn't even keep up with inflation. People who use indexed universal life, their money, whether it was 100,000 or $1 million, was double or triple that at the end of the 12-year period. Does this arouse curiosity? Do you want to understand why and how? So the message is this. When the market goes down, you don't want to lose. You may not make very much, but as Will Rogers once said, people get more concerned about the return of their money instead of the return on their money when the market goes down. And then when it comes back up again, you want to participate without your money at risk in the market. And people go, how can you do that? Well, let me show you. This is that same 12-year period superimposed here. And I'm going to put on top of this what indexing would have done. But when you look at it, that was only about 1/3 of 1% compounded annual rate of return if your money was in the market in that 12-year period. That's pretty pathetic. But see, with indexing, maybe you didn't earn as much when the market went up because there may have been a cap. It's called a cap. But people got credited 0, 1, 2, 2.34%, but they didn't lose. And then as soon as the market turned around, they started making money. Maybe not quite as much, but look at this. Because they didn't lose, they had 130% increase whereas money in the market only had a 4.68% increase. Huge difference. So how does that equate? If we go back to 1975, the year after I started, and I had a Series 1 securities license, if I had money in the market, $500,000 in the S&P, it shows here in the red, I would have gone up and down like a, heartburn, up, down, and so forth, but I would have ended up with maybe 5.6 million. People say, that's pretty good. Hold on, you haven't seen the whole picture yet. With indexing, I would have had 8 million. But that's not the whole story. Remember Paul Harvey, the rest of the story? In the market, if you earned 5.6 million over that period of time from 1975 to the end of 2010, in the market, you would have had to pay tax on that, at least at the end of the day with the tax-deferred IRA or 401k. You have to pay nearly 1.8 million in tax, you're only netting 3.8. And you have all this heartburn in the meantime. In Index Universal Life, you don't have any heartburn. You don't lose when the market goes down. You can sleep at night. And you end up with 8 million tax-free. What would you rather have, 8 million tax-free or 3.8 million? Hamburger A or hamburger B? It's that simple. So this is why I love Index Universal Life. And you don't have to use it just for retirement. It's like the dream solution, like a financial Swiss Army knife for death benefit, retirement planning, for college savings. This beats a 529 plan, working capital for business or real estate management, emergency funds, lump sum capital transfer, estate planning, pension maximization if you're a school teacher. If you don't know what that is, you got to search this channel. So this is the beauty behind max funded IUL. You don't lose when the market goes down. You make money when it goes up, and it's tax-free. So how can you learn more? So you can learn how many people in the year 2021 locked in gains on their Index Universal Life of not just 10 or 11%, but 25%, 61.33%, and even 153%. Meaning the next year, if the market crashes, they don't lose one dime of that they made the year before. If you want to learn more about this, I want to gift you a free copy of my most recent best-selling book. This is flying off of our warehouse shelves. It's called The Laser Fund. It's actually 2 books in one. This one is for the left-brain thinker, all the charts and graphs and explanations here. If you're more of a right-brain learner, you flip it over and read this one. This is 12 chapters with 62 actual client stories and examples if you learn more by stories. If you want to use the right brain and left brain, you read both, okay? But this will teach you how to diversify and create the foundation for a tax-free retirement and how to have, 40 to 60% or more of your retirement income be protected from market volatility and not even show up on your 1040 tax return. The IRS will know you're receiving it, but they'll know it's tax-free. So go to laserfund.com to claim your free copy. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book. Click on the link below and claim your free copy to understand this, or you're going to lose.